Great, thank you. So Eszter and I have the pleasure to tell you a little bit more about how you could do it. I will kick off with introducing the impact-weighted accounts framework. Then we have a joint slide, and then Eszter will take over from me. So, what is it? And those who know Werner know he's very passionate about the impact-weighted accounts framework. And Hajar even has a hashtag for this quite abstract concept that has made it quite popular on social media. Quite popular. So, the starting point is, as Werner said, we want to go to a society that creates value to people. But we have to realize that we're coming from very, very far. As you know, in 1970, one of the smartest economists, Milton Friedman, said that the social responsibility of business is to increase its profits. And actually that has driven and is still driving large parts of the economy. Perhaps the reports are a bit greener, the package in the supermarket is a bit greener, but at the end of the day, this is still very much what is driving global markets and thus business. Ask Emmanuel Faber. But you do see a need, a deeply felt need for people in business, but also their stakeholders, employees, the clients of business, that has to change. That it's not sufficient to make profits for shareholders, but that you want to create value, true profits for each of your stakeholders, including future generations. Treat the slides kind of as pieces of artwork, as we don't have the time to go over them in detail. But then there is one small problem for that part of CEOs, CFOs, but also managers, employees. If you want to create that true value, well, this is the problem. You have no idea. As a business, you don't know the value you're creating for your clients, for your employees, or for future generations. You don't know. So actually, you're in the dark. Well, our colleagues at the Harvard Business School, they wrote a report and was called Impact-Weighted Financial Accounts, the Missing Piece for the Impact Economy. Well, we dropped the financial, that was too long, but then we thought at the Impact Economy Foundation, we should partner up with those guys. So together with HBS, but also with Rotterdam School of Management, Impact Institute and Singapore Management University, we bundled the different experiences, real-world experiences of businesses that have done that, into the impact-weighted accounts framework. Hundreds of pages, but you have a specific section if you're a CEO or if you're a technical analyst. So you may wonder, isn't there sufficient data? Because there is a lot. There's a lot of sustainability data, a lot of impact data, and it's increasing by the day. The new CSRD regulation, SFDR, will increase the amount of data, also improve it. However, the problem of all this data is that it's not fit for decision-making. A study by MIT, they said that, well, everybody uses different indicators, but even if they use the same indicators, you cannot compare them. Hey, you have CO2, you have FTEs of child labor, you have water and land, and you cannot really use that for decision. As a result, if you look at the top rating agencies, MSCI, S&P, and the others, their credit ratings correlate 99%. But their sustainability ratings correlate around 0.5, 0.6. So whether a company is doing good or bad depends on which rating agency you do. So, one illustration. This is very brief. You see an impact fund of Goldman Sachs, an impact fund of a Dutch impact investor. They're almost the same. There's, well, the one is 1,000 times larger than the other. But if you would like to compare the returns, the societal returns of these impact funds, you cannot do that because, well, the Goldman Fund does better per dollar invested on CO2, but that's all they report. And the Dutch one, they report on other things like social conditions, so you cannot compare that amongst many other things. So then they've put in a lot of time, but then as an investor, you don't have the information to choose which one is better. So it's not useless, but it is, well, almost useless. So impact-weighted accounts enable businesses and people in businesses to answer the simple question that you need to answer. Is A better than B? Yeah, from an impact perspective, if I want to create value for society. And that is the question that you need to answer, right? Because you are making decisions every day. So, why is this important? Well, for the group of decision makers, CEOs, who really want to create true value, and there are quite a few of them, they cannot. So, by presenting this, you enable them to take their responsibility, that Pauline has mentioned, to create long-term value creation for the stakeholders in society. So you empower them. But there's another use, because of course there's a large group of leaders, managers, CEOs, CFOs, who kind of feel it, but they're still fumbling, and now they get an easy path, right? Because it's so complicated, because you have CO2 and water and all these regulations, it's all too complex. So in this way, you make the choice very simple for every decision that is relevant. And then you can start your therapy session, because the way it is a therapy session. I don't know who you know Irving Yalom, which is was one of the foremost existential psychologists. And he says that in his sessions he focused on two undeniable truths, and it's not death and taxes, but he said everything fades and alternatives exclude. Yeah? So first, alternatives exclude. If you choose for B, for example, more fossil fuel, then you're not choosing for A, more clean energy. Yeah? So you cannot have your cake and eat it. And it's very important to take the time to realize that if you're in your therapy session with your CEO, or perhaps with yourself, or with your fellow board member. And the second truth is that everything fades, right? So at some point, we're dead. Irving Yalom was an existential psychologist. So it's not enough to say, well, in 5 years' time, next year, perhaps when my career as board member with all the liabilities has ended, then I will choose for A. No, now is the moment to do that, so that you don't need to live with regret, as very many people do. So let's go back to the accounting. So how do we deliver? If you look at the impact-weighted accounts, the foundation is integrated profit and loss. So if you take the normal profit and loss, it's a great piece of machinery developed over many years. So it measures very well the value creation for one capital, financial capital, on one stakeholder, on one stakeholder, the shareholder. So what if you take this great piece of machinery and you say, we just have to make it more complete? We're adding the other stakeholders. For example, if you pay wages, that's a bad thing on your P&L. It costs money. But from a societal perspective, it's good because people can buy things with it. Same with taxes. And the other step is that you say, well, we shouldn't only focus on financial capital because, for human well-being, broad welfare, we also need social relations, human health. So if you sell lots of products that make people unhealthy, then you're not doing a good thing. Human capital, but also natural capital. And there we're talking about CO2, but also ecosystems and biodiversity. So by broadening your perspective, you can create a true picture of your value creation. It doesn't need to be perfect. It just needs to be better than the complete darkness that we're living in now. Then on the right-hand side, you see an example. It's from DBS Bank, to show it's also outside of Europe. It's the largest bank of Southeast Asia. And they had the question, okay, we want to invest more in electric driving. We get pushback from our people because they have to say no to clients. Is electric driving, has better CO2 from the driving, but is it really better if you include making the engine, if you include not only CO2, but also the materials, the conditions? And then if you do the exercise, you actually see that depending on where you're driving, it is better on average. It's not perfect. You still have CO2, you still have materials, but it is the better choice. So you can go to your account manager who provides those bank loans and say, this is better. Then the other part that it solves is you don't want to bring everything to one number, right? You don't want to force people with their choice. On the other hand, you can also not make decisions on 200 indicators. All the minerals, land use, CO2, CO2 from land use, water, child labor, forced labor, harassment, right? So you cannot also give all that list. So in the impact-weighted accounts, we try to focus what are the essential criteria, and then different organizations make different choices. But you give them the right amount of information that a decision maker, that a board needs. Not the 200 indicators, that's too much, but also not the one number that takes away the autonomy. So the first one is you want to create value for all their stakeholders, so the net value creation per stakeholders. Because if you create value for your clients, your employees, your shareholders, also your shareholders, and society at large, they will come back to you and don't run away. However, you don't want to create net value creation at the expense of others. You want to respect human rights, respect planetary boundaries. So you have to separately steer to stay within planetary and social boundaries, and you can quantify that. And the third, you don't only want to do less harm, you also want to do more good. You want to contribute positively to the Sustainable Development Goals. And that is the third. How do you measure your contribution to sustainable development? And then if you're different organizations, suppose you're a hospital or a philanthropist, you may put more value on shareholder value. If you're an impact investor, you may weigh them. And if you're a listed company, so I have to deliver good returns to my shareholders, but in a way that I increase the pie to society. So, the nice thing about impact-weighted accounts is that it wasn't started as an idea and then we see who can implement it, but it's based on the actual experiences of businesses, you see a couple of them, who were already doing this and translated into best practices. There are different principles, because it was thought for each of the challenges, like how to be complete, how to miss anything, how to weigh different impacts, how to attribute it, because you create value in a value chain, principles were made so that you have a principles-based approach to do so. And that brings me to Eszter, who is a practitioner, who is one of the I'm not, but Eszter is one of the co-authors of the Impact-Weighted Accounts Framework. And we focused on thinking why the Impact-Weighted Accounts Framework, why now, how does that value, and does it fit with other frameworks? Eszter.
Thank you so much,
Can I give
Adrian.
the floor to you?
Thank you so much. Thank you. And it's a pleasure to be here. So thank you for listening. And hopefully you'll have lots of questions and feedback. And hopefully many of you have responded to the recent public consultation on the Impact-Weighted Accounts Framework, which has run throughout the summer until recently. So the point is, why IWF and why now? As Adrian said, first of all, there are already practitioners who are experimenting with measuring in a comparable unit by monetizing their impacts, positive and negative. So the IWFs are not out of the blue. They build on previous work, and they're consistent with monetary valuation of impacts. You can also, I think if you've looked at it, and hopefully you will look at it soon, it's about tailoring to your needs, where you are in the journey, how far you can go. We actually had a discussion in the working group recurrently about what's the value of actually companies starting to apply the impact-weighted accounting framework or the principles, and not necessarily publishing a report at the end of the first cycle, but more kind of doing their self-assessment, their learning internally to build up the momentum and the confidence to then eventually publish it. Why now? If you, we've mentioned some of the regulations in the pipeline and already in place, such as the Sustainable Finance Disclosure Regulation, SFDR, the CSRD, the Corporate Sustainability Reporting Regulation, the Corporate Sustainability Due Diligence Directive, just to mention a few. All these increased focus on transparency and disclosure are a wonderful momentum where everybody is looking for clarity. If you've been trying to implement any of these frameworks internally, I think you're looking for clarity. So you probably will welcome to look at how the IWFs are looking at monetizing and comparing impact. There's also, we noticed, I've been working, used to work at the Global Reporting Initiative for almost a decade. And that was a wonderful experience. And we've seen that some companies are at the beginning of their reporting journey and others are kind of graduates and they're looking for the next thing. How can they go even further? And you have now more and more companies who are past the standard sustainability reporting and are looking for, okay, how do I actually make this more meaningful? And they're the perfect audience for the impact-weighted accounts. As mentioned, it kind of really fits well together with the other frameworks, and it does add value both to reporters and report users. I'll talk about that in a moment. Again, this is similar to the slide that Adrian showed a moment ago. Is like, how does this all fit together, and where do the impact-weighted account and the impact-weighted accounting fit into the picture? If you look at kind of, we're all focusing on climate because we see that as the most acute and most chronic risk we're all facing and well, already living the consequences. Looking at the broader than sustainability, ESG, and non-financial reporting frameworks, and then looking, narrowing down to looking at more impact-related disclosures and the work of also the Impact Management Project and UNEP and others. And then finally, kind of really showing the connection between the Value Accounting Network, the National Capital Protocol, and the Value Balancing Alliance, and how that feeds into the IWF. So again, this is just to give you a bit of context of how this all fits together, that it's not out of the blue, and wherever you are in your journey, you're somewhere on this continuum, and you can see how you can build towards impact-weighted accounting and reporting. So if you, hopefully you're all familiar with all the different documents, and if not, I hope that you will soon become familiar with them. But basically, it's good to know that it's an array of documents, 6 documents. And depending on where you stand in your journey and what you want to do with it, you can pick what you should read. Because if you look at the introduction, it's more the big picture of why is this important and why now. If you look at the conceptual framework, it gives you a more in-depth explanation of what IWF is about. The framework itself is the actual document where you will see all the definitions and principles and requirements. Again, this is relevant to an array of different user groups. And then depending on how much more in-depth you would like to go, you maybe have some questions that are unanswered, like, what do you mean monetizing impacts? Or, you know, what is really the value for each stakeholder group? Or really a step-by-step guide of, okay, I get it, but what do I do? Like, where do I start collecting data? So all these documents are then supporting that process. Of course, the summary is, I think, where many of us would start, concise, to the point, you get it, then you can see what else you could make use of. So hopefully you can soon visit the website and download them or read them for yourself and come back with questions, because the whole point is you have a theory, but you need to turn it into practice. Very briefly, there are lots of benefits, both for companies and investors as data users. I was looking at it, you know, you can read it for yourself. I think you should always be in control, so it shouldn't depend on IVAS for you to be in control as a company. But it's also about integrating into decision-making, being an attractive employer, meeting regulations head-on, and being very transparent on the company side. And on the investor side, well, I work for an asset management company, and we certainly want to know, the companies we invest in, what is their long-term value creation strategy. So increasingly asking for this. With
cool.
that, thank you.
Thank you, Eszter. Thank you, Adrian. Can we get a big round of applause, guys? Okay. We're a bit short on time, but I would like to maybe see if there's a question from the audience. But maybe before I do, can I see hands if people were familiar beforehand with IWF? Can I see some hands? Okay, and now I want to see all those hands. Who read all the documents that Eszter asked you about? Because if you didn't, then you need to get out, guys. It's a precondition. But that's good to see, but it's also good to see some people that haven't heard of it before so that they know now. They can spread the message, spread the gospel. Is there somebody who has a question for either Adrian or Eszter in the room? Over there, yes. I will go over with the microphone. Sorry. Coming through. Personeel, as they say.
Hi, Sandra Pellegrom. I'm the National Coordinator for the Sustainable Development Goals. So thank you for including those. And I have a question about that. From the government side, what we usually tell in our narrative is that, yes, first and foremost, respect planetary and social and governance barriers. And this is really encaptured in following the OECD guidelines on corporate governance. Secondly, try to contribute positively to more SDGs, and that is your value creation. So my question is, I think it conforms very well with what you're saying, but why are you making a distinction between 1, value creation in society, and 3, contributing to the sustainable development goals? Because from our perspective, I think those are the same, and it would make the framework even more, clear cut, I would say.
Okay, thank you for the question.
Great question. The reason is we try to be faithful to the SDGs, and there you see that not all value creation is covered by the SDGs. For example, if you pay out salaries in the Netherlands, if people are not below the minimum, that wouldn't contribute to the SDGs. So in this way, we think it is important. Also, salaries in the Netherlands are important, and many other things that do create value. But we can imagine that it's also important to create extra weight to paying salaries to those people who otherwise would be poor. So you can have that extra focus. On the one hand, it matches the SDG indicators. On the other hand, you also allow to have that extra distinction between welfare and, in particular, sustainable development. Yep.
Okay.
The example you mentioned, but I mean, this is legislation in the Netherlands. So can you claim that you're positively contributing value to society if you're just conforming with minimum wage legislation?
No. I'm saying that, for example, if you you hire 2 extra employees. I'm a baker. I hire 2 extra employees. Without my employment, they would also have, a living standard. But still, I'm creating value for those employees.
Okay. Thank you for the question. Thank you, Adrian, Eszter. Can we get another round of applause for them, guys, please?